Welcome to this Masterclass Explainer. If you've ever wondered exactly how micro, small, and medium enterprises, MSMEs, are literally bypassing traditional banks to raise capital, well, you are in exactly the right place. Today, we're diving deep into a really fascinating report from the Islamic Science University of Malaysia. We're going to explore how Islamic alternative financing is absolutely revolutionizing the digital economy. Let's get right into it.
Okay, let's look at our roadmap for today. We're going to cover an overview of the platforms, the Sharia principles governing them, the regulatory framework, market performance, industry challenges, and finally, the future direction.
Kicking things off with Section 1, Overview of P2P and Crowdfunding.
Think of these digital platforms as absolute game changers, really hero solutions for MSMEs. Normally, these smaller businesses get totally locked out of corporate banking because of super strict collateral requirements. Basically, crowdfunding and peer-to-peer or P2P financing in the Islamic capital market act as digital bridges. They directly link entrepreneurial firms with capital providers. By entirely bypassing conventional commercial banks, they cut down on administrative costs and skip those tight credit conditions that usually leave unbanked MSMEs out in the cold.
Now, there are actually four main types of crowdfunding, and we can split them right down the middle into two categories. On one hand, you have nonprofit models meant for social welfare. That's your donation-based crowdfunding, which uses social funds like zakat for charity, and reward-based crowdfunding, where backers get a cool product or service instead of cash. On the flip side, you have the profit-driven models designed for capital market investors. This includes equity-based crowdfunding, or ECF, where investors actually get company shares. And then there's debt-based P2P financing. That one is huge for managing day-to-day cash flow because borrowers pay back the capital over time without giving away any equity.
To really get how this works without charging direct interest, which is of course strictly prohibited in Islamic finance, let's look at a real-world scenario using an asset-based commercial contract called murabaha. Imagine a halal food firm desperately needs raw materials. Investors pool their funds on the platform to buy those exact, tangible goods. Then those goods are sold back to the firm at a cost-plus profit price. So, to wrap up our first section, these platforms aren't just moving imaginary money around, they are actually ensuring the productive circulation of wealth within the real, tangible economy.
Moving right along to Section 2, Sharia principles governing platforms. The absolute core of these platforms' legitimacy is their strict adherence to Islamic law. You really need to know these four foundational contracts. First, mudarabah, which is profit sharing. An investor provides the capital and the entrepreneur provides the labor. Next is musharaka, a joint venture where everyone shares both the capital and the effort. Those two are super common in equity crowdfunding. Then we've got murabaha, the cost-plus sale mechanism we just talked about. And finally, wakala, an agency contract where the platform acts as the investor's agent for a fixed fee. P2P lending actually relies heavily on these trade and agency mechanisms.
So why go through all this? Well, it's about what these contracts are designed to avoid. Riba, which is interest or usury, and gharar, which means excessive ambiguity or deception, are absolutely strictly prohibited. No exceptions. Everything here is grounded in the core Sharia principle of al-ghumb bi-al-ghurm. Basically, that mandates that any financial gain must always be accompanied by shared risk. You just cannot guarantee a risk-free return in this system.
And this actually brings up a huge debate in the market right now. There is a very real danger in just slapping trade-based Arabic names onto transactions while totally ignoring the underlying economics. It's not enough to just play dress-up. The doctrine of substance over form dictates that true Sharia compliance requires substantive economic compliance, not just a label. To quickly summarize Section 2, a healthy Islamic market absolutely needs a deep, structural balance between authentic risk-sharing and continuous Sharia governments.
All right, that brings us to Section 3, the main regulatory framework.
Listen, financial innovation is fantastic, but it absolutely requires boundaries. Under Section 34 of the Capital Markets and Services Act 2007, ECF and P2P platforms are not licensed as traditional banks. Actually, they are legally categorized as recognized market operators, or RMOs. This is a very specific legal designation designed to foster innovation, but keep strict legal oversight in place.
Now, what's really interesting here is the sheer weight of responsibility placed on these platforms under the RMO guidelines. The obligations are intense and completely non-negotiable. Platforms have to conduct rigorous due diligence on issuers, ensure absolute investor protection, and maintain bulletproof risk management.
Plus, they have to guarantee Sharia governance by appointing qualified advisors, strictly adhere to anti-money laundering and counterterrorism financing laws, and maintain top-tier cybersecurity. It's a massive undertaking.
And this whole ecosystem only works because of a really smart dual watchdog system. You have the Securities Commission Malaysia, the SC, acting as the primary regulator for the capital markets. They're out there actively facilitating the growth of ECF and P2P. Meanwhile, Bank Negara Malaysia, or BNM, is in the background ensuring overall financial stability, heavily focusing on things like cybersecurity and digital payment governance. To wrap up Section 3, this complementary oversight protects investors like you and me, while safely letting MSMEs access the funds they so desperately need.
Let's move on to Section 4, Market Performance and Growth Trends.
Okay, we've talked theory and rules, but let's look at the real-world impact, because the numbers here are staggering. Get this, 10.7 billion ringgit. That's the cumulative amount of funds raised purely via P2P financing between 2020 and 2025. It's huge. It proves that businesses are increasingly ditching the old ways and turning to these digital portals for working capital.
And if you combine P2P with equity crowdfunding, that number jumps to 11.5 billion ringgit, benefiting over 20,000 businesses across the country. This phenomenal growth hasn't just happened in a vacuum. It's been spurred by key government initiatives, specifically the Capital Market Master Plan 3, or CMP3, and the Malaysia Co-Investment Fund, known as MICEF. MICEF is really cool because it actually co-invests alongside private investors to help lower the risks.
And within that massive pie, Sharia-compliant fundraising is absolutely surging. It jumped from making up 24% of total funds in 2023 to a solid 30% in 2024. So the takeaway for Section 4 is crystal clear. P2P and ECF have officially matured. They've gone from being these fringe experimental options to mainstream pillars of the capital market, totally driven by this growing appetite for ethically conscious investments.
Moving to Section 5, Challenges Facing Islamic Platforms.
Now, despite those massive numbers we just looked at, the road ahead definitely has some serious roadblocks. The report points out several tough barriers. Right off the bat, there's low public awareness and a huge gap in financial literacy. People literally just don't know these options exist. Then you have trust issues and information asymmetry. Basically, investors don't have enough data to comfortably trust fundraisers they only ever meet online. Add in constant cybersecurity risks, incredibly complex regulations that are hard to keep up with, and technical limitations for smaller platform providers, and it's a lot. To summarize Section 5, until we solve this information asymmetry and really boost financial literacy, way too many MSMEs will remain unnecessarily tied down by conventional banks.
Which leads us perfectly into our final section, Section 6, Future Direction and Opportunities.
So how exactly does the industry overcome all those hurdles and evolve into a fully integrated economic ecosystem? Well, the answer lies in deep tech integration. Right now, manual processing is a massive bottleneck, but by bringing in artificial intelligence and machine learning, platforms can perform instantaneous credit risk evaluations for unbanked MSMEs. And even better, smart algorithms can run continuous automated Sharia monitoring throughout the entire financing lifecycle. This ensures operations remain totally free of riba and gharar at lightning speed, which drastically cuts down those administrative costs.
And this is building into an entirely new market dynamic called co-opetition. It's exactly what it sounds like, cooperation and competition. It's a strategic alliance where traditional, risk-averse Islamic banks actually team up with fintechs. The banks start using digital P2P structures as their deal origination pipelines, essentially co-investing right alongside retail investors like us. This brilliant framework bridges the SME financing gap while keeping banks safely within their strict regulatory risk boundaries.
And that brings us to our final thought. The overarching takeaway of this entire explainer is really captured perfectly in this quote from the report. The ultimate goal is fulfilling Maqasid al-Sharia, the higher objectives of Islamic law, through equitable wealth circulation. It is all about uniting tech-driven efficiency with institutional capital to democratize finance for absolutely everyone. So I'll leave you with this provocative question to chew on. As AI auditing and digital co-opetition become the new normal, will these agile digital platforms eventually replace traditional SME corporate banking entirely? Thanks so much for focusing in with us today, and keep learning.